So this first segment, Financial Foundations for Farmers, we spent a little bit longer talking, but I think that was really valuable. So I will move a little bit faster through this. I also feel like we're a little ahead because I covered some of this with each of you on our calls. So we're going to talk a lot about the chart of accounts and how it is the foundation for everything and how we want to approach like getting that put in place. We'll do a top to bottom review of a profit and loss and a balance sheet and how those statements talk to each other. And just a little bit about bookkeeping hygiene and how to spot errors and know that things are kind of going sideways, in the books at least. Then we'll do a short break, just like the bathroom and drink break. And then we're going to do, sorry, I'm scrolling the wrong way. And then we're going to talk about financial metrics and ratios a little bit. So like, how do we understand if the numbers on the profit and loss and the balance sheet are performing in a way that's going to help us? We're going to talk about what are some of those numbers that we want to look at and what do they mean. And then we're going to look at a case study where I actually have financial statements and some statistics from a few different farms in different places around the country. I'm not going to tell you the whole story on purpose, right? And then we're going to look at the financial ratios and actually practice, like, how does that tell us a story about what's going on the farm, which will highlight how we can use them for ourselves. But yeah, it's not meant to be like, here's everything to know about the farm. We want to leave it a little bit of a mystery and solve it together in this group exercise. Then after lunch, we're going to like roll up our sleeves, get our hands dirty, and do budget building. And Ashley was really generous with her time, and we worked together to like prepare a sample from her farm, and we'll talk about how we built it and look through it and train you guys how to do it on your own. And we have a couple other tools that we'll go through this afternoon as well. So it's going to be a pretty packed agenda, and I'll walk you through some of the paperwork in here, and I definitely want you guys to go home feeling like you got a lot of information today. So before we begin, though, let's just like take 1 second and get ready, because this is going to be a lot of stuff, and I'm really excited to work with you guys. So just take 1 second, close your eyes, think about maybe like 1 or 2 things you'd really like to take home with you today, and let's just have like 1 minute of silence to just start to integrate into this work. Okay, thanks, guys. All right, so let's take out packet number 1. There is a glossary of financial terminology in here. These are paper clipped or stapled by module, so you don't have to worry about the other ones till we get there. If you have questions about the words I am saying, you are definitely not the only person who has questions about the words I am saying. So don't be afraid to ask. In the back. Is that one? Is it not in the first packet?
No, it's at the end.
It's in the end.
Oh, okay. You all have copies of the slide deck that you can write on, and etc.
Is it like a single page?
It's a packet.
Oh, this one is
It's like the first one.
at the end of your.
At the end of your first packet. Sorry, I should have gone from top to bottom, but I took mine apart already. Is she missing this one?
It's just underneath. Yeah.
That's the first one. That's the slides.
There we go. Okay, cool. So I think, can I look at yours? And do you prefer Andre or Andy? Okay, cool. All right, I'm going to use Andy's packet so that we can all see from top to bottom.
Okay.
This is a copy of a profit and loss statement with a 3-year comparison. So I just want you guys to know what you're working with. We're going to get to that in a couple minutes. And then we have your slide deck that we're going to go through. So feel free to use that as like your notepad. And then the glossary of terminology. And then we have a couple of exercises behind that. So just get your papers ready, and I'll just tell you which one to grab when we are ready to get there. But there's quite a few documents in this segment, and we're going to go ahead and just dive in. So let's go. So I'm gonna keep my intro super quick. I have worked with kitchen table consultants for 8 years. We believe in making farm and food businesses profitable for good. That is supposed to be a pun, right? We work with sustainable farms and environmentally conscious farms, regenerative farms, and the food system organizations that take them all the way to the marketplace. So small food manufacturers, food hubs, and nonprofit and government agencies like RC&D that do education. So these are the areas that we work. The advising and coaching is with business owners like you guys one-on-one, and then we also do training. The advising and coaching covers these areas: strategic planning, bookkeeping, financial coaching, and marketing. On the prior screen, Taste Profit Marketing is our sister company, and they do all the marketing execution. Build your email funnels, build your website, like create marketing materials, do all different kinds of campaigns. They do a really great job at it, very efficiently because of the way that they have their experts networked in the organization. So we merged this year, and now we're a team of 18. When I started with KTC, it was just myself and the 2 original founders 8 years ago. And so when I moved, I grew up in Philadelphia. I moved to California when my first child was born, to be closer to family that have all left Philadelphia, as I'm sure you can relate to from Detroit. Like, get out of that big city, that big cold city. Let's go. And then decided that we wanted to move up the coast to somewhere a little quieter. And I live on the central coast of California in Morro Bay. We also do leadership training for farms that have managers, like bigger farms that have managers managing their people. How do we teach them financial responsibility and also good leadership within the organization? These are the principles that we work by, right? All of our senior consultants have been business owners. My husband and I owned a very small farm for a very short period of time. It was called Frimmer Family Farms. It's my last name. And we grew hydroponic lettuce in a high tunnel in our backyard in Philadelphia. We had like an urban farm in Roxborough. And so at the same time, my husband was a firefighter, and I was also managing an urban farm nonprofit organization, and it was just too much, all of it together. And then after I left the farm I was managing, I got into consulting with KTC, and we never picked farming back up, although we do have our own like kind of urban farm property where we live right now with like 4 8-foot raised beds, 13 fruit trees, and a berry bramble on a very small, less than half an acre urban property. This is what keeps us up at night. Are we delivering more value than we cost? And we take that really seriously. I've owned a couple of other businesses in my life. I started my life in hospitality and entertainment management, and I owned a production company, and then I managed restaurants and other event venues for a period of time, and then made a very conscious decision after a personal health crisis that like food is the future, and changing my career as I also healed myself through food. I have an MBA, which is where like the financial focus comes from, because I grew up in a family-owned business, and I always believed that like business practices are the core of any successful business, and that's what I aim to share. All right, so financial foundations. Let's get into it. We're going to go through chart of accounts, reconciling. If you don't know what that is, we're going to find out today. We'll go through the profit and loss and the balance sheet, and we'll do a couple exercises for each. This is the foundation, right? Like every accounting system leads to these financial statements. And so if we're not yet in an accounting system, the goal is to get there at some point and then be able to produce these reports. They tell you a lot about your business, and we're going to show you why and how. I think we covered this morning, right? We farm because we love it, but we also need to support our families and our communities and make our impact. And so I think India said it well already too, that like getting comfortable with working on the business is what's going to ensure that we can keep doing this for as long as we want to do it. So why is financial record keeping important? And I think, so there were 3 people on the attendance for today that aren't actually here today, but are going to be involved and watch the videos and everything. But I think all of you have QuickBooks. And after, whether you're using it directly or indirectly, you all have that baseline for your accounting system. And so all of this stuff around keeping good hygiene in the bookkeeping system, reporting your farm sales activities in a timely manner, recording expenses in a timely manner, recording banking and credit card activities in a timely manner, are going to lead to be able to doing these things. But the key being in a timely manner, right? If our books are really far behind, we don't have a good picture of what's going on. But when we do have a good picture of what's going on, we can get our invoices paid because we know what's outstanding. We can track our cash flow. We can know our cost of production. We know what we've invested in our farm and what we really want to get out of that investment over time. Year-end profit forecast is a good thing to know, especially like starting to plan for next year and your own personal budget. Knowing when you need a loan or credit, getting to that ahead of the curve is really important too, because lenders don't like to make those deals when you're already like this much towards the bottom of the bank account. And if you don't have your balance sheet in order, they don't know the value of what you've invested in your farm or the value of what you own. And that's generally what they're going to base your borrowing ability against. So having this stuff up to date can be really helpful. You want to go buy something. Can you afford it? This one's often like, did I deposit that check? Where'd that payment go? Right? So we want to have these times that we carve out to keep these things up to date so that when there is a question that we need to figure out, it's pretty easy to find that information. So how do we get there? What are these like bookkeeping hygiene practices, like brushing your teeth in the morning and at night, right? Every single week, it's getting sales receipts and invoices into the system. So like if you come home from the farmer's market, there should be like an end of market process for putting that information into your bookkeeping system and recording it somehow. So, you know, do you have a farmer's market checkout sheet that's like how much you sold in different tender methods? Or are you doing it all through like credit card swipes and you can access that through another portal like Square or Stripe? We've got to get that information into the system. Now, if you guys weren't all using QuickBooks already, I might speak to this a little bit differently because some people might be doing like more rudimentary systems in Microsoft Excel. But since you are all already making the investment in an accounting system, return that investment for yourselves and do it in there. Do it in one place and keep it consistent. Reporting expenses should happen weekly. So meaning like the banking feed is often directly connected to your bank account in QuickBooks, and those transactions are sitting there for expenses. Or if you're reimbursing yourself from like personal receipts, that should probably go in some other folder or organized fashion. Like in the very beginning, starting with a client, I'm always like, where are you keeping your stuff? You know, like, do you have a bin on your desk where the bills and the invoices go? And then when you have your bookkeeping hour on Friday morning, you go through it. Or is everything in the truck? And you've got like, just like a bunch of folders or receipts like on the floor of the truck. Because then we can start maybe with like one of those little plastic expandable files with like the paper spiral thing to keep everything tucked in. Or if you're always just like momming it and you have your giant purse, like maybe you need a little portable file to stuff the receipts in that isn't your wallet or isn't that thing that like doesn't live in the business, right? Just a little bit of high level organization, thinking about place. So every week we want to classify and record those expenses. So if they're just sitting in the banking page, like they're not showing up in the reports, they're not in there, they're waiting for review. And labor use versus projections. So we'll talk about this more later with what I really mean by this, but like if you have a budget for labor, you have part-time people helping on the farm, or you're doing an event that has like a specific labor budget, right? Mm-hmm. And you look at that labor budget when you're planning your schedule, like that's often where we miss the mark, right? Like I put labor on the budget and then I shoved the budget like under the desk until we reached a cash crisis, right? But like doing that work, you want to refer to it on that monthly basis. My labor budget for each week is, you know, $400, and that means X amount of hours for my employee that gets Y dollars per hour, right? That basic algebra. But then going, okay, I can't ask them to stay and do more work unless I'm conscious of the fact that I'm going to be paying them more than my budget. So is there a later time I'm going to pull back? Am I expecting to sell more stuff than I originally did? Am I just like knocked out with the amount of stuff that has to be done and I'm going to take that cost on the chin? Just like knowing that you're consciously making those decisions. Yeah. The monthly stuff is like comparing actuals to budget, right? We did our budget, we did our QuickBooks. Now we're like kind of halfway through the next month and we want to do those comparisons. How are we doing? Are we out of scope? Are we in scope? If we're out of scope, how long has it been that way? And when are we going to make changes? And we'll talk about that more specifically too. Reconciling accounts every month. We'll have a section on that. Monthly financial review and key metrics, right? So like that sounds really overwhelming. I'm going to have metrics and I have to calculate them. And what does it actually mean? But I think after our ratios module, it'll seem a little simpler. And like maybe you have like three key metrics you want to look at for your farm. Is it, you know, your labor to sales ratio? Is it your total sales per week or total sales per month? Or is there some other metric that is important for your farm to understand how you're performing sales per acre farmed? Like, what is that? We'll talk about that a bit. And then on an annual basis, right, we want to do a strategic plan. That's something we're going to talk about this afternoon, which is just a fancy way of saying, why am I doing what I'm doing, right? Like if I want to get to a certain goal, putting the strategy bubble around that just means like breaking that down into some pretty specific actions and time frames to get to a goal, right? And then if I'm going to take these actions to get to the goal, and I chop it up into little bits. What are all the little bits that I have to do to get to each action that's going to get me to the goal? And if you take the time to really think about it, and then you put stuff on a calendar or project manager tool, then you can just like roll through it and manage changes as they happen. But as we all know, like if we don't strive to achieve something that we want to achieve, it might not happen because we can't just necessarily, although beautiful coincidence happens often, we can't necessarily just count on the universe to provide like the whole process for us, right? We got to take some action. And then we want to build projections to understand what our sales are going to be. And we usually look at that by customer or by sales channel or by crop and build a budget. I have an opportunity assessment tool for deciding if I want to invest in this or that, and I'll share that with you at the end of the day. All right, so Peter Drucker, management guru, somebody that you run across in business school a lot, but what gets measured gets managed, right? If we're not measuring it, if we're not paying attention and we're just like going head down, got to get it done, we're probably not managing it. We're just letting it happen. So I said I would say this phrase about 1 million times today, and I will. Chart of accounts, why does it matter? But what is it, first of all? We all talked a little bit about chart of accounts on the phone. So this is my diagram about how all this stuff is related and the different financial statements. So we have a profit and loss statement in front of us. We'll go through it in a couple minutes, but those are all income and expense accounts. The top is all the money that comes in, and then the whole list at the bottom is like all the ways that money comes out. And that makes up the profit and loss statement. And then the balance sheet is our other financial statement. We have a sample balance sheet right here too, the one with the gray box on it. Balance sheet is a statement of worth, and this is one day in time. And this has assets, which is what we own, liabilities, which is what we owe, and equity, which is how much we've invested in our business, or others have invested in business. So if we look at these two things together, we don't see the same stuff on them, right? So if we're only looking at one of these statements on a regular basis, we're not really getting the whole picture. And we're not necessarily seeing a place where errors can fall into the system. Here, are you missing one? Okay, fine. I don't need it. Thank you. No problem. All of these categories that you see down the left-hand side, like looking at this one, income, produce income, packaging, seeds and plants, right? Those are all accounts, the labels. The accounting terminology for these labels or categories or buckets is just accounts. So this list of names is called the chart of accounts. And this is the organizational system that we use to build the profit and loss and to build the balance sheet. So usually when we look at this income statement, which is also called a profit and loss statement, they mean exactly the same thing. We see the income that the business produces in its everyday selling activities. And we see the expenses that go into the everyday selling activities. But things like loans and equipment purchases aren't considered regular business activities, and they don't appear here. They only appear on the balance sheet statement. So we want to talk about the bridge between the statements a little bit today and understand like how they integrate. And so when we look at our profit and loss, it's going to become the template for your business's budget, right? And then be able to build monthly projections from there. Because why would you build two things that you need to compare on a very regular basis in two different formats, right? That doesn't make any sense. We're going to use one format for everything, and then comparisons become clearer, quicker, easier to manage. And then we have a balance sheet, right? And in order to understand the impact of the balance sheet, we also need to understand what is the debt schedule. Who do I owe and when? If I have loans, I have to pay them. Eventually the loan will be paid off. Or sometimes things have like a balloon payment or whatever. So we can create a debt schedule. Then when we connect the profit and loss to the debt schedule portion of the balance sheet and any other investments we're going to make in the business, even if it's not through debt, we can arrive at cash flow. But there is often a disconnect between this net income number at the bottom of the profit and loss and how much cash is sitting in the bank. They're not the same thing, right? So the way that we connect those is by understanding what we would call additional cash inflows and outflows. So like let's take a retail example, like the store behind us, right? Like if they buy a bunch of inventory and they're sitting on it for a few months, like goods that don't expire, that's not going to show up in the sales, right? And it wouldn't necessarily be considered the cost of the goods sold because they haven't been sold yet, right? So inventory is an asset, but it doesn't necessarily show up here depending if you're doing your bookkeeping properly. So we have to consider all the other ways that cash might be coming in or out to get to cash flow. So we're just going to start with the profit and loss, so the one with the 3 columns on it. And the basic theory is that we want to boil it down to 7 numbers. Like we talk a lot within our organization about how the numbers can be overwhelming, just like the actual quantity of numbers for review. It's a lot. It's often too much. So when you look at a statement like this, you're like, oh, how do I analyze this? This is probably like 50 lines. And so when everything has a hierarchy to it, or we build these parent accounts, these profit and loss parent accounts, we can collapse the system down and just look at the 7 numbers and then decide where we want to open up and look at the numbers within that section. So if we can take our profit and loss and build it into these 7 categories, then from there we can have a simpler system for analysis. And when we do our budget example, we'll talk about how we did that with Ashley's Farm pretty quickly. Like we took a look at Petalum's chart of accounts, talked about like what accounts were delivering like mixed up information and maybe separating those, but still keeping them sub-accounts within these greater parent accounts. And we rebuilt her chart of accounts pretty quickly into this structure. So I want to encourage after today, everybody to actually go and do that. Because then when we meet next and we're applying the budget building process, if you guys all have this system working, we can talk to each other about it. Like, you know, in your business, Asia, fixed expenses might look really different than the hundreds of acres that you guys are managing, and then there's some that you own, right? So there's like a mix. Mm-hmm. And so we want to be able to talk about some of those things. Or if you are doing really similar things, you know, cost of labor is going to be an interesting comparison against a peer that's like doing similar types of work. So before we get into like what kind of expenses actually go into these, I just want to talk a little bit about the structure. So when we have income coming in and then we have cost of goods sold, income minus cost of goods sold is gross profit. So what's cost of goods sold? And again, like there's a glossary here to take home with you guys if you want to take a look at any of this stuff throughout or later. And don't hesitate to ask questions because everyone's got them. So the cost of goods sold are the direct cost of the product. And somebody walked in with a Starbucks coffee cup earlier, and that's always like a pretty easy example for everybody to digest, right? The cost of goods in that Starbucks coffee are, like anyone want to shout out what some of the direct costs might be?
The coffee.
The coffee.
Packaging.
The
cup, the band, the lid, exactly. The milk if it's a latte.
The labor.
So labor is an interesting one because, yeah, direct labor, we can talk about breaking that into cost of goods sold. And I think it depends, like, how far you are in your bookkeeping evolution personally, because it's going to be a lot easier to keep all the labor together right here. When you get to a certain point where you can actually separate it, there's a lot of value in understanding the direct labor up in the cost of goods sold. But like on Ashley's Farm, you're doing floral design, right? So to be able to sell flowers for a wedding, like a designer is going to put that together, and that would be a direct cost. Or you're contracting somebody to do like a farm to table dinner event. So the chefs and the caterers really be the direct cost of that event. So those would be cost of goods sold there. I think when you're on like a diversified crop farm, it can be really hard to separate out the direct labor versus like the back office sales and administrative labor right away. So I would say like get your books in order first and start doing all that categorization, and then think about adding like finer layers to the process. Don't try to do everything all at once. That can get really overwhelming. So income minus COGS is gross profit, minus all of these is net profit. So this is really the first measure of profitability of an enterprise. So on a farm where you're doing a whole lot of different stuff, it's important to have an understanding of the gross profit of each work area. Like, Kyla, you guys are doing children's tours, and then you're also growing the ulu, right? So there's different cost of goods sold there, and the gross profit on the ulu is going to look different than the tours, obviously, because you need to wait for those trees to mature and harvest, right, as an example, versus like a tour is coming and they may pay money right now for the tour. And the only direct cost might be your time, unless you're giving them some like printed things and activities to take with them. So this is an example and trying to like, you know, get it working for everybody around the room. So we'll talk a little bit next about subcategories and how to break this up. And the example in front of you, like I'll pull this up on the screen in a second, but we'll walk through what this looks like in each of the parent categories. So those 7 numbers, we call those the parent accounts. And then we call these the sub-accounts. So like sub-accounts of general and administrative expenses might be all the back office stuff and marketing stuff. Or professional fees, like I had a lawyer come and do a contract template for my wholesale customers this year or whatever it is. Operating expenses, here's just 2 examples, right? Fuel for running the crops around, repairs and maintenance on the stuff on the farm.
Is there a reason that, like, for example, income is 400, they have a certain number, 600 for labor? Are those numbers significant for those particular categories?
Where are you looking?
Well, like,
oh, yeah, okay.
And 800 for general admin.
Yeah, so that's a good question. So a lot of businesses number their chart of accounts, and as like a standard practice in an accounting system, you can enter a number for each account too. Mm-hmm. And I think when companies get pretty big and lots of people are working on the books, it's easier to say like, look at 601 instead of like, go find, payroll expenses in the labor section.
General admin.
Right. Okay. So yes, and there's not like a hard and fast rule around the numbering system. People just kind of create it. Okay. So, and this is a good time for me to say this also. There's a 2-page template for chart of accounts in here. One of them does go onto the back. And so we have an example of a numbering system on here.
Oh, I see.
Yeah. And so we call this our Farm Vitality chart of accounts. I want you to think about this like a menu. You're not going to use every account on here. But if you don't, if you want to look at a big picture of like, what's everything that I might put on a balance sheet, or what's everything that I might put on a profit and loss, and then just kind of shave down from there, there's 2 templates here for you to work with. The reason I'm calling attention to this right now is because this is what it would generally look like if you just exported your chart of accounts from QuickBooks from the lists area, and it would give you an export like this, and then you could analyze it. There's probably a lot of junk in here that's like pre-programmed from QuickBooks too that we didn't include in our list.
What did it say at the top of that sheet?
It just says KTC sample account list.
Oh, okay.
And so the reason I want to bring this up now is because a lot of times people say, like, I can't really remember what goes where. Like, I went to the hardware store and bought supplies, but then I bought, like, greenhouse supplies, and I have a different account for greenhouse supplies than I do for, like, building maintenance supplies. And so, where do I put that? And I think the most important thing is that it should be consistent. Like, I don't care how many different kinds of supplies accounts you have, but, like, have a system for what's going in each one if you want more than one. And so thinking about that, like, do you have equipment repairs and maintenance and vehicle repairs and maintenance separate? If you do, you got to put those expenses in the same place every time. So that's kind of where things can get confusing. And sometimes if you have a bookkeeper too, like, they're not really attentive to your consistency of accounts. They're just like blazing through the categorization, right? Yeah. So when you have a template like this, what we like to do is like tell people to create a legend. Add a column that's like, hey, what goes in here? Types of transactions for this account. And you might be like, lumber and basic hardware supplies would go in this type of account, where, oil changes on the vehicle and like new tires would go in this type of account. So you can easily like create a system where you can notate. When I was managing an urban farm that was a nonprofit organization with literally 14 programs, and I'm going through all the like department managers' expenses and trying to make sure they're categorized in the right place, our chart of accounts was a lot longer because we had 14 programs. And so I had a legend for the chart of accounts that we printed out, and I laminated it, and it was like in the top drawer of my desk. So when it was time to sit down, I laminated it because the first time I spilled my coffee on it. And then, I'm going through the chart of accounts with like the different receipts in the bin once a week. Like I pull that out and I'm actually looking at it, because this remembering what expenses go in what account is probably like pretty low on your rung of priorities. So if you just create some tools for yourself, you can be consistent.
Would you like, if you went to the store and bought things that went to 2 different accounts, you separate it and like.
Yeah, but I would do it on the spot. Not everybody does that. Like I would literally stand there like at the counter with like their silly like, pen on a rope and like put my notes on the receipt, or you go back in your car and you do it real quick. So it's, you just can, then it's subtotaled. I mean,
I'm sorry, I missed that question.
When you have a receipt with multiple stuff on it and it has to go in different accounts.
Oh, okay.
I think if you don't do it like close to the time of purchase, you're just not going to remember.
I have this bag, and every time I go into it, I want to cry. And it's all those receipts.
It's all those receipts. Time of purchase, it takes like 1 second. But the other thing that I recommend for people that have like multiple people processing receipts, because it just makes it easier. But like I had a little custom stamp created at Office Max, you know, and it would be like name or initials of the person, and then like it had like category, line, total line, and it had like 4 or 5 places to do that. So you just stamp it on the back of the receipt, and I'm like, this kind of supply $20, this kind of supply $40, and it was just done. So, you know, it's the kind of thing you can keep in the truck in the glove compartment.
How would you add tax in there? Like if the end you.
Yeah, I mean, it's never a perfect system. I would just always throw it in the biggest category, but like, you know, it's not perfect.
Because that's always the tax.
Yeah, I mean, if you think about coming home from like the hardware store with a $200 receipt and how much of that is actually taxed, like, you know, I would just throw it on the biggest one, but you could do it however you wanted.
Sometimes what I do is just like try to separate, like depending on where it's gonna go, and then just like go in the cashier and then just have like one receipt. It's gonna
One receipt
go,
for
like,
this.
with
Yeah,
the
if you can do
supplies.
that, that makes it
Just-
easy for you too. That's really smart.
Yeah.
Yeah. I mean, when I was doing the farm management thing, I was in Philadelphia, and you know, like lines and the stores like that are so long, so I always feel so bad about like doing like the
They love it when you do that.
Okay, so why does the proper categorization matter so much? Because we want to see trends over time. Like we want to understand in operating expenses, is it always around 20% of our sales, or is it changing, or looking even at the whole number of how variable is it? It'll help us do accurate budgets. It'll help us do month-to-month comparison without going like this feels wonky and I don't even know if I'm doing the right thing. And then it just helps us understand decision making. So you'll be able to see like in these accounts going down the profit and loss, which ones do I really have control over and which ones don't I? Like rent, not a lot of control, you know, but how much I spend on these operating expenses or admin expenses, I have a lot of control.
What if you're living on your farm is where you live and you just have a mortgage?
I think like each particular like business entity type has different structures. I can't remember what you are.
LLC.
An LLC. So I mean, it all kind of comes into the personal at the end anyway. You just have to make a decision of like, do you want that to be part of your business and your business pays you, or do you want to have that be part of your personal? I probably didn't say that great. I felt like I just stumbled through this sentence. In some operations, like I see farmers that have 2 businesses. The one business owns the property and rents it to the farm. And then, you know, the farm pays rent to the other business. Or sometimes I see like if they live on their farm and it's a sole proprietorship or something like that, they might have the mortgage right in the business. So it could go either way. And then some say like I have a partner and I bought the house with my partner, and then my business is separate from my personal life, and I don't want to like mix the two. And so maybe they pay rent or maybe they don't. Maybe it's like an in-kind situation. So you just have to look at your family situation and decide how you want to handle it. But if you did suddenly add your mortgage to your books, you'd have to add the asset and the loan, right? Not just one. So, and then the bonus is once you're sorted out, you can compare things with, you know, like find a couple of farmer buddies that you can talk to about this stuff, because it can be really lonely dealing with all the financial strain of the business and not having anybody to talk to you about it. And especially too, if you like work with your life partner too, sometimes you just have to stop talking about it with them for a little bit. Okay, so I want to emphasize keeping it simple. We don't need accounts for every little thing. Most of the time when I review these with people, there's like accounts with like $10 in them. It's like, well, we just didn't have a category that felt right, so I made a new one. But just figure out where it's going to go. You don't need one for everything. Make a change to your legend if you need to or whatever. But we want to set up the income accounts and the chart of accounts based on enterprises, not who our customers are, right? A lot of times I open books with people and I see like, oh, farmers market this, farmers market that as the income accounts. But really their income accounts should be produce, chicken, and resale items, because they raise chicken, they raise produce, and then they buy in additional goods and sell those out. So thinking about the costs of what it takes to actually do business activity helps you understand what the enterprises are, right? Because the farmer's market's not an enterprise. We're selling all the different stuff that we do there. It's just the sales channel. And you guys all touched on your different enterprises. In this conversation, we can get a little bit more into it. But like, obviously, you're doing tours and you're raising, you're growing the cacao, and so like those would be different types of enterprises. If the expense is super small, just don't make one. That's basically what this is saying. I've definitely opened up some books that maybe have like 200 accounts on a really small farm, and it's like, you know, how is your brain going to manage those numbers? So the next section down is cost of goods sold, and like I said, those are the one-to-one costs, like the coffee cup example, and those are the crucial expenses to understand if I want to keep or drop an enterprise. So, like looking at, I'm trying to think of a good example. Like you said, you were doing lettuce, and then you were doing some other crops, but lettuce was your core crop. When you're growing a lot of different kinds of produce, we generally don't put like individual crops in the cost of goods sold and in the income areas as enterprises. But if you're, you know, trying to integrate something new into the farm, like you have your apparel, right, that you sell on e-commerce, that would go separately. And so the cost of the t-shirts and everything like that would go there. And then the cost of raising produce on the farm, growing produce on the farm would go in the other bucket. And so like, let's say for example, you know, you had a t-shirt price and then all of a sudden your provider of the t-shirts and the screen printing went through the roof and you saw your margin shrink. That would be a trigger to say, am I going to raise prices? Am I still making enough from this to make it worth it? Once I slap on like the packaging for the e-commerce and the box and everything, am I still making money? Sometimes we see that stuff, especially in e-commerce. We're priced for a margin, but then we're throwing it in a box and we're adding ice and then we're putting it on somebody's doorstep. And by the time we throw those other costs in there, maybe the margin is so slim it's not worth spending all that time on that activity and potentially finding a different enterprise over time, right? Those are the kinds of triggers that alarm us to, how am I doing here? Do I want to do this? And if I don't love doing it and I'm making, you know, a really thin margin, do I want to keep doing it? Or find something different?
Isn't it true that I feel like it's better to diversify because sometimes some things are really popular and then a few months later that's not so popular and then you have something else that's...
You know, I think that just depends on the market, and that's like more, I think that's more of a question of your market and where you are.
Yeah.
Right? Some things are kind of like core staples, and I think some things maybe not.
I got a quick question. So with the cost of goods sold, so you're saying like for the chart of accounts, you wouldn't want to have like lettuce and collards as separate?
I wouldn't. So the only time I usually recommend that is in like where, you know, some parts of California, like you see these farms that are doing really mechanized farming and they're only growing like 2 crops a cycle, and you know they're harvesting them all in like one swoop and taking them to the wholesale depot, right? They're not just kind of like doing this high intensity farming where we're like feeding our community and eat a variety of things, because then you could see how if you're growing like 20 crops, that would become like a really unmanageable situation. I have, I think that's where like the cost by crop stuff comes in that you're going to be talking about with Tanya, and like really understanding if your price is meeting a margin goal for each of your individual items. I mean, if you were extremely detail oriented and you had the time, you could do that, but I think it would probably make a mess. Just from my experience of what I've seen. Because you're also rotating like the amount of different things you're doing. It's not like, oh, I always have a 1/4 acre of cucumbers and then I also always have a 1/4 acre of peppers, right? They're sharing the land, they're sharing the fertilizer, they're sharing the resources. If it's too hard to tease apart, they probably belong together.
So but like trees versus like lettuce, that's pretty different.
I think that's different.
Well, that's
right?
different. But
I think
we
that's
have like hollow, and then the ulu, and then like let's say pala'ai, or like the squash, right? Or if we did mamaki, so like those 4 different.
The mamaki would probably be separate because of the post-harvest. Are you going to do the post-harvest handling too, or are you just going to sell it?
So right now we are not. We're giving that to somebody who does aggregation and processing. So, but potentially through this budgeting, that might be one way that we scale. But I guess, yeah. So I just wanted to
Yeah, that's a good question. I don't know a lot about Mamaki, obviously, but I think that one still you might do separate. We could talk more about untangling that. But like the squash and those other crops, they're like sharing all the same inputs and they're going to like diversified markets, then I would probably keep those kinds of crops together.
Okay, thank you.
Yeah. But yeah, I think like tree crops, orchard crops would be a separate enterprise than your row crops because you're putting different inputs. You can kind of separate what's going where. And when things are shared across the whole farm, like inputs are shared across the whole farm, they're probably not a cost of goods. They're probably coming somewhere else under the lower sections of expenses.
So it would help to basically simplify, you know, with a main categories so it has to your expenses, right?
Yeah.
So if it was like, oh, okay, like to separate collo and pumpkin, like it would be hard to separate the expenses. It's like, oh, okay, well we bought these fertilizers, but they're going
the same. Yeah, exactly.
Okay.
And I think fertilizers can still be a cost of good, but I think if you're probably using different stuff if you even need to fertilize in the orchard than you would in the row crops. I was gonna say something that I forgot on my tape. I can't remember. It'll come back in a second. I'm sorry. So I just want to talk about margin for another minute, right? So income minus cost of goods sold is the gross profit. And then the gross profit divided by income is gross margin. So one's a number and one's a percent. And I think these words get tossed around a lot, and I don't think it really matters. But just to understand what the difference is. So there's just an example here. If you have $130,000 in income and $50,000 in cost of goods sold, that's $80,000 gross profit, but 61.5% gross margin. It means that you maintain 61.5% of your total sales to cover all the other expenses. So like if you have an enterprise where the gross margin is really low, like maybe 5% or 10%, like is that giving you enough contribution towards the rest of your operation that that's how you should be spending that time, right? Because time is the biggest opportunity cost of doing something else.
And so that would be a good 5 to 10 would be like something, a margin or a enterprise that you would want to consider if you should continue. Like what is the margin that is just like, okay, this may be some area you want to look at to maybe, discontinue.
To discontinue? I think scale is a question around percent though, because like if you're $500,000 farm in sales and you have 10% margin, that's really different than if you're like grossing $50,000 in a 10% margin. But I would say anything under like a 20% gross margin, like you're really questioning whether you want to be doing that. And that's like if also going to like probably the lowest price channels, like wholesale or whatever. If you're doing direct to consumer, like you should see some decent margins on stuff, like 50% plus. Sometimes on like sustainably raised meat, it might be a little bit lower, right? Like 40%. But those are just the kinds of ranges I've seen in the farms I've worked with over the years. So this speaks to your question though. Like gross profit tells you in number. Gross margin tells you how it stacks up against your sales. So in this scenario, we have a farm doing $100,000 in sales versus $500,000. We look at their cost of goods sold and we look at their gross profit. The gross profit numbers are the same, right? But in context, this enterprise isn't giving you as good of an outcome as this one. So one of the reasons we organize the profit and loss this way is because we want to see those income accounts by enterprise and we want to see those cost of goods accounts by enterprise also. So if you have those parent accounts built out, you can compare one versus the other. So like on the profit and loss in front of you, actually I have a better example with more than one enterprise, so I wanted to keep this one simple. I'll come back to that in a second. Let's talk about reconciling for a second. So we spoke earlier about I might want to skip ahead for a second. Yeah, okay. Just pretend you don't see all these slides and I'm gonna skip ahead. Okay, so this is the profit and loss that we have in front of us just on the bigger screen. It's just so it's easier to all look at. So for this particular farm, like every farm has a story and a scenario, and I don't like to just make up numbers for these things, so I just like pull stuff out, and then it helps us learn why separating works better. So in this particular case, this farm's doing a CSA, but they have to buy some of the stuff from other farms because they don't have enough to fill the basket. So that's why we only see really one category of income and one parent category of expenses. Right? She wanted to see this separately, so we pulled it out on one line, but we're really looking at this number in this particular case.
I'm sorry, can we start over with that?
So we have income.
Okay.
Year over year, we see an increase. And then we have cost of goods sold. And the cost of goods sold of the products going into a CSA basket. Does everybody know what CSA is? Like the mixed basket subscription to the farm. There's packaging, there's seeds and plants, and then there's like one-time use supply in this particular case. And then we have a total produce cost of goods sold. So she can see everything it took her to grow all those crops and get them bunched and into the box. But then didn't really have enough to fill the CSA box. So also purchased some product from other farmers.
Okay, that's where I was okay. Okay, I see.
And then a total cost of goods sold. And then we see the gross margin figures, right? 87 and 85 were pretty close, and then we had a year that went down a little bit because it looks like maybe she oversold the CSA or had a crop failure and needed to just buy more stuff. She also spent a little bit more on seeds and plants though, so it would make you think that she was planning to grow more, but then it really just didn't work out. And then once we get to that gross profit number, we see that there's a significant contribution to the rest of the business. And then we start to go through the rest of the profit and loss. So we have the labor and the subcategories, and then we see the labor to sales ratio too. There's a big jump here, and we'll talk more about that, like what these metrics are telling us. But basically, compared to sales, she put a lot more staff in. She's probably planning on harvesting a lot more stuff, but the sales didn't pan out as much as she wanted, and she had to buy more crop because something didn't work out. So this is like a scenario of what happens in a bad year. Right, and that might tell us, like, last year was kind of crappy. When I go to build my budget for next year, I want to look at the year before, too. Because I don't want to really just base it on this one year where everything
And so as the percentages goes up, that means that it was a worse year.
So in this particular, so it's different depending on the metric, but in this case, it means that 40% of her sales were needed to pay for labor. But the year before, only 23% of her sales were needed to pay for labor. So it just means like efficiency on labor didn't pan out.
Right.
So Rebecca, is that an example of how you do the metrics of like labor to sales?
That's one example of why the labor to sales ratio metric is important, and we have a whole segment on ratios after this one too. And then we can see her operating expenses. So these were all the things that we're talking about that go into the process that aren't like easily identifiable as being put in that cup of coffee from Starbucks, right? So some tool and equipment purchases that aren't on the balance sheet because they're not big enough one by one to be on the balance sheet. So it's not like she bought a car, but she bought a lot of small things. Supplies, the credit card fees, fuel, fertilizer. Some farmers like to put this at cost of goods sold. I don't need to, like, I think I said yesterday, I don't need to die on that hill, like fighting with you about where it should go, but put it in the same place every time. So if you want it in OPEX, cool. If you want it in COGS, cool. But do it the same way every time.
Well, where would you put it?
I mean,
Where did you put it?
I put it in cost of goods sold, but one of my coworkers that I do a lot of trainings with, like, she was an organic farmer for 15 years, and like, we'll just never agree on where we think it should go, and I think that's okay. I know a lot of farmers that like it in cost of goods sold.
Wait, versus what?
Operating expenses.
Oh, okay.
Like shared operating expenses really do move up and down with sales. Like the more you sell, the more supplies you're going to use. The more you sell, the more you're going to drive around. The more credit card fees you're going to have. So these are also variable costs. They're just not so easily distinguishable as all the ingredients of something that's going out the door. And then you have your general and administrative section. So these are all the back office things that happen. Food and beverage, so that's just like buying people dinner, staff stayed late, office supplies, bank charges. And then we have the fixed stuff that we really can't control at all. Insurance, taxes and licenses. Again, utilities is one. People like to debate me and put it up in operating expenses. I think it depends on how you use utilities on your farm. Like if you have a heated greenhouse that's gonna like jam a lot of utilities for part of the year, like maybe you would put it up there. but put it in the same place every time. And then we can compare across again for the last section here. One-time expenses is an interesting one. I see this one as a placeholder because a lot of times one-time expenses are something that is going to end up on your balance sheet when you go meet with your accountant, right? Like maybe you bought an electric vehicle, but if you bought it in cash and you put it on the balance sheet right away, then your net income is going to look really, really, really different than what's hanging out in your bank account. Or let's say you paid yourself, or let's say you went and you built a new website or something that you're not going to do again next year in your budget. I also think that it goes in one-time expenses, and you can put subcategories in one time. But like, you know, an expense for marketing like that, like building new branding stuff or putting up a new website, it's going to stay on your profit and loss. But if you put it in one-time expenses, when you go to build your budget, you don't have to like go picking apart all of your categories to figure out what's happening again next year that you want to look at. But then the other thing is about one-time expenses is that you may have something you need to move to the balance sheet with your accountant at the end of the year. But what happens when we put things on the balance sheet as busy business owners and entrepreneurs, and when we put them on the balance sheet right away, is that there's this huge disconnect between profit and cash. And we kind of lose sight of what's really happening. Or if multiple people are like spending on credit cards and the bookkeeper is handling it, and it goes on the balance sheet, like it goes over the business owner's head, right? And it's like, oh, I didn't even see those transactions. I didn't realize that. I didn't remember that. And then we get to a point where there's a cash crunch, and it's like, oh, I wish I had booked this differently. I would have been able to see it. So, you know, if something is going to end up on the balance sheet, that's fine. You can use a journal entry with your accountant to move it later. But I think it's great to be able to see, like, what's my cumulative one-time expenses for the year? Like, am I completely going nuts here, or, you know, do I still have budget to spend? It's going to help with that decision making of, like, can I buy this thing or not?
How do you show things that that might sit on the shelf?
Like inventory, you mean?
Yes, I have a ton of inventory.
Yeah, you specifically have a lot of inventory. I don't know that anybody else is hanging on to as much inventory as you are, although you have livestock inventory. Yeah, so there is a process that's going to be a little bit more work for you, and I think we could talk about it more specifically afterwards. But there's like a monthly journal entry process where, let's say you receive a shipping container of beekeeping supplies, right? And let's say that container costs $20,000 to purchase. That $20,000 is going to go on your balance sheet in asset inventory. Then each month, when you look at what you've sold, the cost of the goods sold, that's why it's called cost of goods sold, right?
Yeah.
You would journal that cost of goods sold off of balance sheet and onto the profit and loss. Your bookkeepers should be able to do that for you. But that means you have to do a monthly inventory count.
Yeah,
Yeah, I know.
No, there's like, I couldn't do it right now. It would just be insane.
You gotta self-talk yourself. You can do it.
I have multiple, yeah. It's
I mean,
ridiculous. I have hundreds and hundreds
They
of
have
stuff.
the
right now.
quantity on the pallets.
No.
Well, we can talk more about it, but the inventory system is really important. Otherwise, you don't know the margin on like what's going out the door.
I've talked with my bookkeeper and she's like, well, you're going to have to start doing inventory. I'm like, I don't have that. I don't have enough hours in the day to do the inventory and do all the other things.
Yeah, I mean, you could do your quarterly inventory if monthly is too much. Like, find a place to start.
Yeah.
But that's like a huge investment, right? We want to make sure that that's working out. A lot of times too with folks that do sell meat, right? Like once you get into meat and you have a freezer full of like inventory, you got to count that.
Mm-hmm.
You got to rotate that too. You know what I mean? It's time consuming, but it is definitely part of the booking and accounting process. And also you want to make sure you put that inventory on your balance sheet, you know, that you're holding. Yeah. And then let's say something happens in your farm and you need to go borrow some money. Like if that inventory is not sitting on the balance sheet, they're going to be like, oh, what do you have that's worth something? Why would I lend to you? You know what I mean? So having that on the balance sheet's useful in some ways too.
Because if someone doesn't physically go to my place right now, it looks like I'm not making it much or anything almost because it's all sitting in inventory at the moment. Well, a lot of it.
Yeah, and I mean you do want it to sit in inventory on the books then too, right? I always feel like what's going on in the books, you want to reflect what's going on in real life. And so that's one of the things when you're thinking about how to process a transaction that's confusing. It's like, well, did it sell? what really happened, and then it helps clarify it. But we can talk more about inventory another time for sure. So the other income section, a lot of people put grants down here so it doesn't get tangled in with your earned income, right? There's like terms earned income and non-earned income. So putting it down at the bottom might be helpful because as you can see, there's a net operating income from operations of the business. Then we have this other income, maybe we have some other types of expenses, and then we get to what is produced in the net income. In this particular case, this farm was like a sole proprietor, and she was not thinking about closing up the farm because of the expenses of living on the farm as well in that property. So I don't really recommend commingling your personal and your books, but in this particular case, like the rent was being paid on the farm, sort of like what we were talking about before. But I just wanted to walk through the profit and loss from top to bottom so that we could understand those parent categories and chart of accounts, like before talking more about reconciling and why it's important.
Just a
And
quick
then-
question, sorry.
Yeah.
When you said you put the grants under the other income, is that like, like last year when they did all those CFAP, the coronavirus food money that they were giving out for stuff, would that be considered like a grant as well?
I don't know, did you provide something in exchange for it?
Just like inventory count of livestock.
Oh. Yeah, no, I put that in other income.
Other income?
Then when we talk about that theory of 7 numbers and collapsing the profit and loss statement, this is what you get, right? So it goes from, where'd it go? It goes from this to this. Like, if you had to pick which one you'd want to review on a regular basis, this looks simpler, right?
Yeah.
Where's that?
This is in your slide deck towards the back. I kind of skipped ahead because I wanted to show you where it was going.
It's the second from last page.
Second to last page. So we'll come back to it. You don't have to worry about finding it. I just want to make the point that you're dramatically reducing the amount of numbers that you need to review.
Mm-hmm.
And when I say, like, the point of it is to be able to see trends, yes, we're looking at 3 years here, but you might be looking at January, February, March.
Right.
And then, is this moving the way it should be? They're not all supposed to be consistent, right? A lot of times we invest in cost of goods sold and then use that over time, or we'll make, like, have labor in the busiest harvest season be higher, and that's fine. But this lets you look at something that is a little bit more easy to make sense of, and then you can open up the sections that you need to go deeper on. All right, so I'm going back to reconciling for a minute. Reconciling is a process in QuickBooks when you like take your bank statements and you compare it to the numbers that you've put in. And so we're making sure that we haven't missed anything. We're making sure we've categorized everything. And if you're doing it on paper and you're not doing it in QuickBooks, you still want to do a reconciliation process where you're comparing the two. You got to get all your statements together, settle in, grab a cup of coffee, get through it, because before you know it, the next month is here. So we always recommend to do it by the 10th of the month for the month prior.
So Rebecca, just to like kind of give a bigger framework. So first we learned like why it's important to have parent categories, to have the ledger. I might add this as homework for all of us and to challenge ourselves to maybe build out like, this to kind of collapse the 7 categories and be able to do a comparison, however you want to do it monthly or 3 years. But now we're learning why it's important to reconcile so that we can trust the numbers that we're using. Is that kind of now where we're going? Like,
yeah, I mean, that's why I skipped ahead. I wanted to show you what's going to come out of the effort of reconciling, because if we don't reconcile, the information may or may not be accurate, right, that we're actually reviewing and making decisions from. So ideally, every week you categorize your transactions. If everything's hanging out in there that hasn't been done, you got to get that done. And then you use your statements to make sure that it works out. And then it should prompt you to complete the reconciliation with a 0 difference. Now, I know that there are some perfectionists out there. If your reconciliation discrepancy is like $2.14, you might not want to spend all the time to like dig and figure out what was wrong. But usually what it is like there's a check that somebody has that they haven't deposited yet that's sitting, or something just hasn't been categorized correctly. Like, something ended up going on the balance sheet that, or, something just came in weird in the feed and it needs to be removed as a double because you already did an entry and accepted it and then it came in the banking as a double, right? So that can happen. This is just like some QuickBooks speak and thinking about coming back to this later. If you get stuck, you have this slide of like what are some things that could go wrong. Probably won't make a lot of sense out of context, but QuickBooks ends up making suggestions for what accounts things should go in, and a lot of times it's not the right one. So if you add something that just needed to be matched, then you're doubling it. We already talked about this, like mid-season decision making and accountability, and having a simple system that gives you information to build on, a guide to how you want to have your spending go, is the reason that why you want to set all of this up in the first place. We're a little bit behind time, so I am gonna skip that activity, but I'm gonna do the balance sheet one with you. We talked about this quite a bit, right? The profit and loss, the history of the year or the period of time, income and expenses line by line. We have to categorize frequently and accurately for this to be accurate, and then it does not include property, assets, and liabilities and loans. We want to be able to make comparisons and come to conclusions and just gain more insight by looking at the trends. So we just went through this. Like I said, I skipped ahead.
Can I have a question?
Yeah.
Okay, sorry.
No, not at all.
For your time reconciling and doing transactions, all of that, where do you keep that expense?
So I think you're going to keep all your labor together, but if you're not paying yourself, you might just want to keep a record of how much time you're spending so that you know, like if the business, when it does. So I mean, I'm specifically thinking about tree crops that take years to come in. So like if you're not paying yourself now, but you know you're going to pay yourself later, like you might just want to know how much time you put in to determine if there's like other activities that you want to add onto the farm as enterprises to get where you want to go when you're planning your budget. But like, let's say your business is bigger and you're paying somebody to just do back office work a few hours a week, it's gonna go into labor. If you end up paying a service like a bookkeeping service, that's probably going to be in your general and administrative expenses because now you're paying a service. Yeah. So just to show you guys, I did talk about this a little bit with each of you on your own. But there's this like worksheet for building your chart of accounts that I want you guys to take home with you. And it has like the 7 parent categories we talked about. And then it has like some samples of accounts kind of scrambled up and thinking about where they might go. So I think we can just talk about like a couple of these and then go on to the next thing. Does everybody have this? Okay, so let's just look at the first one, fuel for the farm. Does anyone want to shout out like where you think that would go under the parent categories on the left? Operating, awesome. How about wages for farm staff? Labor. How about produce sales? Income. Let's skip down a few. How about banking fees? Awesome. In California, like no one has bathrooms on their farm and you have to rent a porta potty. Where do you think that would go? Operating. Awesome. So you guys get the idea. And if you're rearranging your chart of accounts too, you could use this sheet to just start plugging your subcategories in below each one.
For the bathroom, maybe be fixed though, because you just pay the same amount for the whole year, or you increase your labor, then you need more bathrooms.
Yeah, so that's another one of those points. Like it doesn't really matter as long as you do it the same way every time. But yeah, usually they can be seasonal, right? So then you might not do it as fixed. And then, so back to where we started, right? The chart of accounts is this like heart of the ability to view all these things clearly. All right, so let's talk a little bit about the balance sheet because this is generally the thing that trips people up a little bit.
Are we still in the same book or?
We're in the same book, but I'm going to pull out this balance sheet example too. Okay, so when we look at the profit and loss statement, we know that there's a goal of wanting to make a profit, right? When we look at the balance sheet, the question is often like, why? What's the point? What are we trying to get out of it? And over time, you want to be able to see an increase in net worth of your farm, especially if you're not paying yourself the salary that you're looking for right now, right? I'm increasing my wealth in the assets that I own and what I'm building underneath my feet. So a couple things to just note, that when we have a liability like a loan that we're paying, there's interest and there's principal. The interest is an expense of the business, right? It's not contributing to the value of the asset at all, right? The interest on your car loan, does that make your car worth more? No. So that ends up going in the fixed expenses on your profit and loss. We don't see loan payments on the profit and loss. We just see a reduction in the amount of the liability, the money we owe. So those transactions have to get split. And then there's also the question of like the assets that we own, the tractor, the house, the mortgage, or whatever. Are they depreciating or are they appreciating, right? Most of the time we see land values go up. If we are raising cattle, we see that value appreciate over a 2 to 3 year cycle, right? But then the tractor is definitely depreciating, right? So there's those annual changes that we need to enter with our accountant. And so we want to make sure that we understand the difference between the liability and the asset and that they both show up on the books.
Just so you know, Toyota trucks don't depreciate.
In Hawaii.
In Hawaii.
300,000 miles,
Right.
so good.
Exactly. I know. My friend's Honda was like still driving after it caught on fire. So this chart always balances. The assets, the top section of what we own, always equals what we owe and what we've invested, the liabilities plus the equity, right? Like the way that it's built in this database, QuickBooks is just a database. It just holds and manipulates your data. It has to balance. Net worth is calculated by assets minus liabilities, right? So as you pay things off, the net worth is growing. So we'll just go through this balance sheet real quick from top to bottom because I want to make sure that it's understood. So it's on your paper in front of you too. The first part's always the bank accounts. Notice how we have a cash box. This is the thing that like goes to the farmer's market and always has $200 in it. And this is the petty cash. This is like that envelope of, it's the envelope of insanity. But no, we want to keep a ledger in there too, right? Sometimes people have both, sometimes they don't have them. But if you do have them, you should utilize them on the accounting documents. Accounts receivable is like what the restaurants and wholesale accounts owe us that they haven't paid yet. That's also one of the differences between profits and cash because we account for the sales, but we haven't received the cash yet. And then undeposited funds is usually just a placeholder account in QuickBooks. So I received all these checks for my CSA. They're sitting in the drawer until I go to the bank. And then once they go to the bank, they go from undeposited funds to the checking account. After we have our current assets, the things that are more liquid, we have our fixed assets. This is the farmland. This is the farmland value adjustment for appreciation. That's done with the accountant at the end of the year, and then the total fixed assets, right? They don't have other fixed assets, so we have total assets there. And then we start to go into liabilities, right? This is the part, page 2, that has to equal page 1. We have bills that we haven't paid yet. We do want to enter those in QuickBooks. A lot of people don't do that. They just sit on the bills forever. You want to put them in so you can see what you owe. The credit card balances, and those are the current liabilities, the things that are due soon. The things that are longer term liabilities, these are our loans and notes that we pay over time. There's a number of loans here.
Quickly, sorry. So accounts payable, give me an idea of like what an account like that would look like.
Like you put the electric bill in the QuickBooks because you know you're short on cash and you're not going to pay it for 3 months. Or, I don't know, but other things of that nature, right? A lot of times when businesses are short on cash, you know, it's not nice, but they extend the credit kind of on their vendors a little bit and not pay them quickly. Sure, we've all paid bills late in times in our lives. And so we want to know, especially if like the business is in a cash crunch or a turnaround cycle, like that number could be getting bigger and we want to keep an eye on it.
So Rebecca, just as ways to use projections, so say this is projecting cash flow and projecting like when you might need to use, like, yeah, how would you use this sheet, this balance sheet? Maybe I'm skipping ahead.
You're skipping ahead a little bit. I'll answer it briefly. I don't want to get too confusing too soon, but it says it on the screen. These are the long-term liabilities that are going to eventually make up your debt schedule. So the debt schedule is like, who do I owe and how much do I owe them, right? When do I have to pay those off? And also just knowing that you have payables coming up as well would be part of like your cash flow planning for sure. In the equity section, we have like the money that we invested in the beginning and the retained earnings from prior years. So this is showing like cumulative losses that are getting to be less. So there's a couple interesting things about balance sheets that can get messy, but I want to point something out that is erroneous on this balance sheet just to make a point. We have this tractor financing loan. Go ahead and look at the asset section on your paper and tell me what's wrong with that.
It's not listed.
There's no tractor!
Yeah.
Right? So we can look at our balance sheet and find some red flags. What probably happened is that they took the loan into the bank account and then they paid for when you take a loan like that, you never actually get the money, right? Like it finances for the tractor company. So they never put the asset on the balance sheet. So something else is up, right? Because the two sections are supposed to match. So that's telling you that there's some issue that needs to go and get fixed.
Can you point that out? Sorry.
Yeah, so right here we have tractor financing loan, just like we have the mortgage and the other loans payable. And then when we go back to the first page and we are looking at the assets, we see the bank accounts and we see the farmland, but we don't see the tractor, right? So every loan should have a corresponding asset. Some of these other liabilities, right, like some of these smaller loans probably just went into the bank account and were used as operating cash. So like they don't have a corresponding asset. The asset was the cash. And when we received the loan, that business checking account probably went up and then it went out the door in expenses, right? But if you're taking on an asset and a loan, both of them have to show up.
So every loan should have a asset line as well.
Unless it's for working capital, right? Just for cash to run the business, in which case you would just see the cash go up temporarily.
Yeah.
So why do we care about all this stuff, right? Because we don't want to be one of the farms that fail. What's the number one reason that farms fail? Lack of profit. Yeah. I mean, we want to be able to make sure that we can keep going. So we're going to talk a little bit about cash flow and how it's different from profitability. We're a little behind time, but I want to make sure I touch on this because I think the case studies are cool and I want to make sure we can look at them. So cash flow is how the cash goes in and out of the business every single day, right? So there's expenses, but then there's also different things that aren't expenses of the regular business. And so this is like a textbook definition of cash flow, but the way I think about cash flow is just all the money coming in and all the money going out. And like we said, those loan payments and things like that don't show up on the profit and loss. Profit is, profitability is when the profit that's earned from the company's core business operations is positive. Profit can be negative, right? We've all seen that on a profit and loss statement. So if your profit and loss statement is telling you that you're profitable, but your checking account is overdrawn, what are some things that could potentially be causing that?
Transactions aren't being recorded properly.
Well, this is a very normal situation that you're profitable and you have no cash. So it doesn't necessarily mean that it's incorrect. But like what could be going on in your business, not on your books, but what could be going on in your business that you're profitable, but you have no cash?
Tied up in assets or inventory.
Tied up in inventory and assets. So you guys are both experiencing that right now. Or you have a ton of accounts receivable, right? Like your customers aren't paying you on time. Which is obviously more common in wholesale environments, right? Because when you're selling over the table, you're taking the money home. So this is a sneak peek at this afternoon. I just want to kind of talk about where we're going so that we understand why we did all of this work. But we're not going to get super far into this right now. We want to get to the point where we can understand where our business breaks even. Breaks even with your salary or just breaks even is like your choice and your call what you want to look at. But if you could model a monthly budget based on this, right? You take your profit and loss, you expand on it as to what could happen in the next year, so creating that next column, and then being able to experiment with it and understand where you're profitable. But then you can also layer on the debt that's owed or any new loans that are coming in, and then calculate that to arrive at what that operating cash looks like. So you can see, like, where is the cash gap? Where do I need to plan to borrow? Because it's really normal in businesses that are seasonal that you have bridge loans or that you use credit cards to bridge the gap. But you want to understand how, when, why, and what the impact of that is going to be, and that you're making the best decision possible. And then from there, we have a little tool called sensitivity analysis that helps to bump up the sales and the variable expenses together so that you can kind of find the sweet spot of where you want to be and say, like, okay, maybe it's not this year, maybe it's a 3-year goal or whatever, but I need to build a path to that if I'm going to keep running my business in this way and also meet my profit goals or my personal pay goals. So that's where we're going next with this. This is just like a little preview of how you take that chart of accounts and build a budget, but then at the end, when we get to net income, we can take into account the debt service and then figure out where we land in cash or any other non-income and expense cash movement. I think for homework, we want to talk about building your own chart of accounts. You can also untangle this activity if you want to, that we talked about a little bit as extra practice. And, you know, we get some office hours down the line. So if you get stuck with your profit and loss chart of accounts reorganization, let me know. I think, you know, balance sheet can get super messy. But it's a good time to take a peek and see if you've got all of your assets and loans on there at least. I would say start with the profit and loss because it's going to be more manageable for you because that's like your everyday activities. So I do want to move on to the next one just because of time, but I also want to make sure that if there's any like burning questions about this packet that we have a chance to answer them. There's 2 different papers on key metrics and financial ratios that just have definitions. I'll let you know when we're going to refer to them and just make sure we have a chance to absorb them. And we're going to talk a little bit about some of the reports that you can generate those from. So I'm probably not going to go through this today, but I think for any of you that are using QuickBooks, like you're all using QuickBooks, take this home. This is some tips about running reports in QuickBooks to get you started in that space.
What's that title of that page?
Monthly reporting list recommendations.
It's inside. Oh, okay.
Yeah, there's a whole lot of papers in there. But it basically tells you, like, what is the report? What can you get out of it? And these are the ones that, you know, there's like so many reports in QuickBooks, right? So this will just give you a good idea of a place to start. All right, introduction to financial ratios. I might skip a couple slides if I feel like we're going a little crazy. So we'll see how it goes. We're going to first talk about like what they are and why we might want to use them. Go over a couple calculations. But I think practice is the best, you know, like rehearsal is the best thing. Practice is the best medicine. So we're just going to go into this case study and play with it. But I want to go over a couple things to start.
It'll get lighter as it goes.
So going back to that quote from earlier, if it doesn't get measured, it doesn't get managed. If it doesn't get measured, you can't improve it, right?
Yeah, I want
If it doesn't get managed.
It tastes how my daughter does. I still have to use that water.
So people always talk about metrics, right? Like, what are we measuring? But they're really just numbers in context related to your goals. So there's going to be a lot of information. Not everybody needs to use all of it. But what's related to your goals? The reason we talk about ratios is because they illustrate relationships. A number by itself might not be that meaningful, right? There was that high and low margin example that we looked at up there. Looking at the same $50,000 gross profit across 2 different business enterprises, that's not really meaningful unless you put it in context against the sales. So that's the point. We have a go-to list of ratios for financial management, and there's a couple handouts in your packet about that. One of them is called financial ratios to consider, and the other one is like a key metrics worksheet that defines calculations. On the key ratios to consider sheet are just some experiential learning that we've had at KTC around what are healthy ranges. But keep in mind they're regions because you guys have more crop cycles here and it's a little bit different. In order to understand healthy ranges, we need to have enough data from enough farms to be able to say, like, this is the experience of what seems healthy. So hopefully over time, you guys can start to develop that together here. So we also sometimes hear this jargon like KPIs or key performance indicators, and it's like just simply said, like they're just the metrics or the, you know, the numbers, the percentages that align most closely with what you're working on. So then they become your key metrics or your key performance indicators. So again, with ratio analysis, consistency is going to be the most important. If you start wiggling around what goes in what accounts and you're comparing ratios over time, then you're not going to have a solid foundation for comparison. And again, peer groups can compare these against each other, and that hot buzzword is benchmark, but it just means compare so that we can share some best practices and have some really good conversations about process improvement. So why do we want to run these metrics down the side of the profit and loss and not just look at a couple key ones? It's really just so that we can see easy indications that certain areas of the business are out of control. And then if they're out of control, then we can focus on improving them. So here's a short version of the worksheet of ratios and what they are. So if we pull out this key metrics worksheet, it just defines what these are on the paper for you guys. So like sales per employee is total sales divided by the number of employees. Well, some seasons I have a bunch of part-times and some seasons I have a bunch of full-times and I don't really know, or it's just me. If it's just you, like it might not be that valuable of a metric. If you're juggling like part-times or whatever, then you might look at full-time equivalents. If you always have 10 woofers, then you're probably going to look at that divided by 10, although like if you're relying on that labor stream, you might not have a lot of control of how productive they are, right? So but looking at that might, you know, tell you something about your future for recruiting that you might want to consider. So we're going to talk about some of these in the context of the case study, but a lot of these are just comparison against sales, right? What's labor as a percent of sales? What is my gross profit as a percent of sales, which is gross margin? If I look at average pay per employee and I'm on a path to trying to provide like living wage opportunities for people, is that telling me something about what I'm doing? So sales per dollar of assets might tell us something about the investments that we made and are they really performing for us? Are we really utilizing them? So one of the things that sometimes we forget to consider is ourselves when we're looking at what's going on with those ratios, like what's going on the farm, what's going on with purchasing, what's going on with the staff, but are we managing things? What's our organizational structure? You know, it may not just be like a cost of input situation, but how are we working with our people? And so the point of doing a case study together is because out of context, like these things can seem kind of hard to understand or a little squirrely. So we want to understand from the case study that we're going to do the value of financial collaboration. And we just want to practice like working with some of the numbers that we just learned about in the profit and loss and financial foundations section and the balance sheet section. And when we put it all together, how does that help tell a story? Why are we telling a story about a farm through financials? Like, why would we even want to do that with our own farm? What are we trying to do? We're trying to possibly borrow money. We're trying to possibly raise investment from other people that might believe in us. We're trying to evaluate like our future and our own ability to manage what we've got in front of us and potentially have conversations like with our life partner about what's happening in the business too, if you're in it together, or potentially if you're in it not together, you know, to explain how things are going. So the way that this case study is built is 4 groups. We're just going to do 3 today though, because I don't think we have enough people to really do 4. And we'll go through them, we'll share some information, and we'll come back together and report what we learned. But I want to talk you through it real quick first. So this packet that says case study for a farm. And then also the one with the green left-hand column. So I pulled some older financials from some farms that I worked with over the years to be able to illustrate like how the businesses have changed through these statements. And so on each case study page, there's a short story about the farm. And then in the bubble, there's some information about like their sales channels and markets. There's some basic operational stats, like how long have you been in business? How much are you farming? How many employees do you have? And then there's just like some key numbers, like that. So 7 numbers plus a couple extra from their profit and loss, some key numbers from their balance sheet, and some of the ratios that we talked about. If you want more information as you're talking with your team about what's going on in the case, you can look at this document. And each of the farms have 2 columns here, right? 2 years of data. And it does go onto the back as well so that we can learn a little bit more about what they have going on. And there's some definitions right here too if you need to reference them. So this also helps to compare, right, against the other farms. This third sheet, if you have time to get into it or want to get into it, is a ranking sheet. So the way that we read this is like, if we're looking at sales per employee, the top performing farm is number 2 in 2018 at $49,000 in sales per employee. The lowest ranking farm, and like ranking quotes, it's not a contest, is farm number 4 with $16,000 per acre in sales per acre, or I'm sorry, in sales per employee. Sorry, not per acre at all. $16,000 in sales per employee. So right away, when you start to benchmark the ratios against each other, we might say, like, farm number 2 is getting a lot out of their team. Farm number 8, it's not working out that way. But there's a lot more in context here. Like maybe it's not supposed to have as high of sales, right? What are they growing? Where are they located? What kind of climate are they in, et cetera. But there's just a comparison thing here. So there's one that got cut off though. And so I just want to say that the second box down in the second column is sales per acre. Yeah, and then the next one should say gross profit, right? That cost of goods sold ratio. And the repairs and maintenance as percent of sales and operating expenses percent of sales.
The second one is per acre, yeah, and then the third one is gross profit.
Mm-hmm. And then the last 2 should just say percent of sales after it, like the ones above. So I will just say that these are all real farms. There's information left out on purpose so that you can kind of question and come to conclusions. Sometimes, you know, when you're looking at these numbers, you might say that doesn't make any sense. And so that might be an indication, right, that something was erroneous in the way it was recorded, or it might be an indication of the way things were operated. So I just want to put that frame around it that you could think about it either way in this situation or scenario. So.
Wait, what do you mean by operated? Like it was erroneous in the way?
No, like when you're reviewing the numbers and trying to answer a question, you probably have to ask yourself, like, do I think they really just made a huge bookkeeping mistake, or is there a better way they could have run this situation? Yeah. Sorry, I'm saying too many words.
No,
I'm starting to get tongue-tied. So I'm going to float around and just help answer questions and things like that. But I think what we'll probably do is just take a look at, I want to throw one of these out because we don't really have enough people. But let's do case study 1, 2, and 4. So we'll do 15 minutes and then we'll just talk about it for a little bit. So don't feel a lot of pressure. All of you guys have the same 4 questions on the back.
Okay.
Has the business gotten more efficient year over year? Where does the business have the greatest opportunity to improve based on the metrics that you're seeing and the comparisons you may make? If you were going to ask them or an advisor some questions based on what you learned about their financials, what are some of the burning questions you'd want to ask? And then what do you think is the most important metric? Like what is the most important one of those key ratios that they need to pay attention to for the coming season?
Okay.
And so I'll put the questions on the board so you guys don't have to keep flipping. And I would just say ready, go, and I'll come float around too.
Are we looking at